this year to get long some names using all three of these types of scenarios. Going to wait about 30 seconds for people to hop on because I started about 2 minutes early. And then we're going to go ahead and get started. Hope everybody's having a fantastic Thursday night. I'm very much looking forward to the long weekend. And for those of you in the Trader Development Program, I will be taking my 1 week of vacation at the beginning of June. For those of you on the market research side, business will go on as usual. I will still be posting the same amount. I'm excited. So I'm going to go ahead and start off here by listing all three of these and kind of talking through each one briefly and then going through real examples. So the first one is going to just be the straight breakout. What do we do when a stock, let's go ahead and number these. When a stock just breaks out, we'll say it's on low volume, doesn't have to be, but on low volume, it breaks out and you're wondering, well, in a high volume situation, we would normally be looking to buy a pullback. What happens on a low volume situation? Should we be looking to buy the same day? We're going to talk through that. We're going to talk about pullbacks. And those are characterized by high volume. How can we actually go through and time the pullbacks here and get some great entries? What are the advantages of waiting for those pullbacks? How can we identify those, build a scanner for those, etc.? And number 3, gap and goes. Typically high volume, no pullback. All three of these are distinctly different. All three of them require a different entry strategy. And so I want to take the next 30 to 35 minutes of your very valuable time. Thank you for spending it with me and going through each of these core concepts. So let's go ahead and start off with our bread and butter, which is number 2, the pullback. So before I get into it, if you're on the Trader Development side, so if you're in Discord, you have access to the TA crash course that I recorded. I encourage you to go through and watch the material. It's an hour-long video that I recorded on breakouts and gaps in particular. You're going to learn all of the different types of gaps, continuation gaps, exhaustion gaps, etc. I encourage you to go through that. It's timeless material. It's going to exist as long as human beings are participating in the market. For the rest of us on the market research side, I want you to go and look at the BRB entry system post here in Playbook. This is a very important post. This is our bread and butter setup. When we post trade ideas, and we post things like we want something above a level, but because there is high volume on the day, we are looking to buy a pullback. This is the entry system that we are utilizing during those trade ideas. This is here for you to learn. I made a video for you. I have all of the stats here to show you why it matters. I'm not going to be going through this stuff tonight because honestly, it's kind of a waste of your guys' time when you could just pull this up and read it at your own leisure. But this is back-tested data to prove that this is profitable. There's edge here. We're going to touch upon this right now. Back over to TradingView. We're going to look at a name that unfortunately did not get posted on Trade Ideas, I don't believe, because it moved too quickly. We're going to look at Reddit. The setup itself, by the way, is the IPO range breakout high setup. Once again, this has been posted just last week, I believe, on Circle. I encourage you to watch that video. It's like a 40-45 minute video of me talking about this specific setup, how you can scan for it, how we found it and traded ARM last November. ARM ended up being over a 2,000% winner for us. Reddit has a similar setup. We'll doubt that it's going to give us the 2,000% move, but this is a winning trade for us, multiple hundreds of percent. For those of the guys, I did not grab this, just fair warning. But this was a perfect example of a BRB. So there are, let's see, 2 or 3 main things that you need to validate a potential BRB. And once again, our BRB setup simply stands for breakout, retest, bounce. If we can identify the breakout, we can buy the retest and profit from the bounce, the BRB. Simple. First things first, what you need is a horizontal level. Seems simple enough. What we're looking for are supply zones, right? Resistance areas that we can reasonably assume, once flipped, will act as support zones or demand zones. This is technical trading 101. It's a horizontal level. It's a zone where sellers are overpowering buyers until eventually selling pressure gives way to buying pressure, and like a coiled spring, price shoots up and over it. Number two, we need to validate volume, but in particular, high volume. Once again, volume is pivotal at pivot points, not necessarily in the middle of trends. We talked about this during the last webinar, all things volume. We've talked about how volume drying up in the middle of consolidation fractals tends to allow those continuation fractals to perform better at the breakout point. We talked about how important volume is at pivot points, at extremes, lows and highs, etc. But in the middle of trends, volume is not that important. I'm sure you guys have heard of the concepts of melt up and everything else. That is typically just trending price action on lower volume. That's totally okay. As a matter of fact, most of the time, that is what's going on during trending market conditions, low volume. We need high volume, though, to validate our idea of a BRB. And the reason why is because Bukowski went through and quantified through a volume study every single horizontal level breakout that he could find. That's an important caveat. He only looked for horizontal levels. Why? Horizontal levels are the least objective breakouts, right? Everybody is going to have a slightly different trend line if you're trading trend line breakouts. Everybody, it's around the same, but when you're looking to have a study, each little penny difference, or sometimes 10, 15, 20, 25 cent difference matters. If somebody's trend line breaks here, but somebody else's trend line doesn't break here, there's not going to be as much buying pressure to validate that breakout because everybody's going to have a different arbitrary line. That's part of the reason why angled trend lines don't work as well as horizontal levels or trend lines, right? Horizontal level is just a trendless line. So what he did is he went through and only quantified the breakouts across horizontal levels because these are not objective. It's a price point as opposed to a slope, if you will. The price point or the zone, when it flips, he realized that volume played a key component, but not in the way that most people expect. When you first learn trading, you think high volume breakouts mean that those are more sustainable. Everybody learns that when you start trading. It's simply not true to a certain extent, at least the way that we're trained when we first start trading. Volume matters during breakouts, but it matters in a completely different setting. As a matter of fact, low volume breakouts typically underperform high volume breakouts by only 1.6% over the course of the move. Now, 1.6% is enough to give an edge to a high volume breakout, but is it really that big of a difference? Would you really skip buying a low volume breakout over a 1.6% average move when we're looking to capture 20, 30, 40, 50% moves? Absolutely not. You should be taking low volume breakouts as well. But what happens uniquely during high volume breakouts is that the throwback and failure rate escalate, meaning the amount of times that high volume breakouts pull back to the original breakout spot and then fail triples. It triples over low volume breakouts. Now, you could theorize why. I have my theories. My theory is that this suckers in a bunch of people. Everybody's looking for high volume breakouts. We know that the market is designed to move money away from naive and inexperienced market participants and into the pockets of experienced and patient traders and investors. So when we get a high volume breakout up and over a horizontal level, everybody wants that. But what happens the very next day? Typically, we get the pullback. There's about a 66% chance that we're going to get a pullback over the course of 1 to 3, 1 to 4 trading sessions after a high volume breakout. Most people look at this pullback as, I bought the top. This is a false breakout. This sucks. What Bukowski quantified was that around 66% of the time we get this pullback and we can reasonably buy this level with a very tight risk level, right? A tight stop out and expect to bounce. This is where this key concept comes into play. So low volume breakouts, which we're going to go through in a second after this, it's not reasonable to expect on average a pullback. So it's a completely different style of entering the name. On a high volume breakout, which we can see here, you need to have this specific setup in mind. Now you can validate volume two different ways. You can either throw some sort of moving average across your volume histogram. I'm going to go ahead and double click it. I have it. Volume MA is enabled. Inputs at 20. That's just very basic stuff. It's averaging out the last 20 candlesticks of volume, and it's giving you that moving average on top of it. Candle closes above it. Reasonable to expect it's higher volume, right? Also, if you're utilizing the indicator that we have on Circle, RVol is up here. All you have to do is look at that and go, is it above 1 or is it below 1? It's literally that simple. We're looking for a high relative volume over 1. In this case, Reddit's breakout up and over the horizontal level, 50 of 50, over 1 RVol. This was like 2 or 3 RVol at the time. We expected a pullback, and that's exactly what we got. The very next day, Reddit pulled back. When you go to buy these things, I guess the last thing we can look for here is that your entry should be within the zone. And this is where discretion really comes in, because some traders are going to go, well, it has to get in all the way to the bottom or I'm not entering. And some traders are going to go, if it's down at all, I'm going to get in. You have to find your sweet spot because risk tolerances are different between traders. Everybody, at least in the development program, starts by trading it my way because I'm teaching it. And then eventually they find their groove and obviously put the little twist on it. I like to buy within the zone. So if I have a proprietary gray box, guys, I'm buying inside the gray box. It's really that simple. I've identified that zone prior to the breakout. I want to own it at that breakout. As Reddit pulled back, once again, I did not own this. I was in Discord as everybody else was buying it, but I had other things that I was buying, so I didn't buy this, which sucks because this ended up being a really good buy here. They bought within the zone. Now, there's two key benefits for here. From an options trading standpoint, what does buying a pullback offer you? It offers you a discount, right? If contracts go up more when the underlying asset goes up, they go down more when the underlying asset goes down. It's not a one-to-one, right? We're trading with leveraged tools. That's the allure. We can take a smaller amount of capital and we can make a lot more profit. We can also cap our losses, right? That's one of the few unsung things that nobody wants to give props to options for. If you're paying a net debit on a play, meaning you're paying something to get into it, that is the most that you can lose. So if your max loss is $500 and you have $500 into an options contract play and you lose that, you don't have to worry about losing any more than $500. If you're trading shares, you're typically going to be trading with a lot bigger size because you have smaller amounts of percentage you're trying to capture, and that stop loss all of a sudden becomes very, very important because those losses can get out of control sometimes. So by waiting for a pullback, you do one of two things. One, options contracts come down. And what we typically see, and what I do, I just had a great question about this actually earlier today on the Up and Comers report. I had somebody ask me, can you append the options trades to this? Normally I would. If there's an options trade on a trade idea, I would prefer to own the options trade in a bunch of different scenarios, especially that we're breaking out into all-time highs, or we were up until today, because typically those calls are going to give us leveraged exposure into big blue sky environments. And that's a great opportunity to be long with theoretically infinite profitability. But if there's no options available, which happens a lot of the time on small mid-cap names, we're not going to go and just try to pull something off the chain. We have to make sure that there is something there. In Reddit's case, because it was a recent IPO and it's Reddit, I don't want to say it's a meme stock, but everybody knows Reddit, so everybody was kind of in it already. There was enough liquidity and volume on the chain for people to go ahead and get in. The day before, on the original breakout, somewhere here, I'm going to throw out a number. I don't actually know what they were trading for, but we're going to say these contracts were $2. What do you expect if the contracts were $2 at $55 for them to be trading at $50 the very next day? They're probably getting them for maximum $1, maybe even less. What does that represent? That represents a 50% discount on the play. It's the exact same setup. It's the exact same play that the guy bought the day before, but you're getting them for a 50% discount because you waited to buy the pullback instead of FOMOing into the breakout because you realize that when breakouts occur with high volume, there's a good chance of a pullback, right? I hope this is totally making sense for you guys. So it's the same trade idea. The guy that bought it for $2 might think the very next day, I'm out. This is a fake breakout. I don't want to own it anymore. This was stupid of me. I'm out. He's selling you those contracts at 50% off, and you're thinking, this is a breakout. I know that we pull back. It was high volume yesterday. The stats tell me that this is probably going to pull back and bounce. I'm owning it. Chances are you're buying the contracts from the guy that bought it the day before. He's selling at a loss. You're buying at a discount. This is really awesome. That's a great change. It's a great exchange, excuse me. What does that do, by the way, in a situation where you're buying, for example, straight calls, even called debit spreads, but straight calls are probably a better example here. You're ramping up your risk to reward because, once again, we might all have the same price targets, which we did, $56, $57. The guy that bought it here on the breakout was targeting $57. The guy that bought it on the pullback was targeting $57. The only difference is the guy that bought the breakout paid $2 per contract. You're paying $1. You're ramping up your risk to reward. So from an option standpoint, it totally makes sense to buy a pullback when you're going long because you're getting a cheaper contract with the exact same trade idea, which helps you skew risk to reward higher in your favor. From a shares perspective, what does it do? Well, if your stop out is originally here and your entry is originally here and you enter on the pullback, think about it this way. If you're entering on a pullback, instead of chasing the breakout, let's say you find the breakout. This was the original trade idea, but you missed it. You're like, damn it, I'm just going to get in. This thing's not pulling back. We're going to enter at 53.27. Here's the original stop out. Here's the original take profit. That is a terrible, terrible idea. 0.65 is rookie stuff. You don't want to do that. If you slide the risk to reward down a little more, maybe you can get it. Let's say, let's put the stop somewhere where it was. Where was it? 52.5, and let's slide the stop up here. Now it's a 1.85. That's still not great, right? We're not looking to take anything unless it's a 3-to-1. So if you're even bringing your stop up to where the original risk on level was to try to like overfit the trade idea in, it just doesn't make sense. Now, let's say we kept the original trade idea on the books, your stop's down where it's supposed to be, and you buy on the pullback. All of a sudden, you're skewing the risk to reward to about 3-to-1. Which is exactly where we want to start our trade. So once again, the guy that FOMO'd into the breakout has a worse opportunity than the guy that's buying the pullback, but it's the exact same trade idea. The entry or the take profit remains the same, and you can tighten your stop loss up, by the way, anywhere because you're buying the pullback. And what's the enemy of buying a pullback? You don't want to hold the stock if it breaks back within this range and get stuck underneath overhead supply, so you can call the trade, you can cut the trade a lot quicker. This is going to allow you to skew risk to reward heavily in your favor on these stock setups, and obviously if you're buying contracts on pullbacks, I do not condone buying calls and call debit spreads into massive up days. This is, I mean, that's rookie shit, guys. I'm telling you, you're going to be paying a massive premium on those. And the worst part is, even if the trade idea is valid and it works, just the fact that you're trading a contract that you paid so much for changes the fundamental of the trade. The entire trade is completely different because you are at a disadvantageous spot in terms of Greeks and premium paid, right? So this is the BRB. This is something that they actively traded. You can see the setup is very valid. You get the breakout, high volume, pullback, buy the pullback. There you go. Bounce up, sell half at 100%. This ended up being a 400% trade for some of the guys. I did not grab it. So fun, quick, aggressive trade. Not all of them are going to be fun, quick, and aggressive. Some of them are going to be slower moving pullbacks, but this is the essence of our BRB. All right, horizontal level, high volume, entry should be within the zone. Don't be afraid to pull the trigger on down days if they're in your buy spots. That's what makes this particular setup unique. Most people want to buy when things are going up. They don't want to buy when things are going down, but there is edge if you're buying when things are going down. If it's in the construct of an uptrend, buy here, don't buy here. Make sense? Cool. That is the BRB. That is our bread and butter setup. I would say 75% of our setups that we enter inside of the Discord follow this basic idea. Buy the pullback. It's healthy for you. The next one I want to talk through are the gap and goes, the Netflix trade. So we took this. This is actually our COD setup. I'm going to go back to Circle really quick. And once again, if you guys haven't watched this stuff, this is seriously valuable stuff. I'm telling you, watch this COD setup. Mike's 250% win on FSLR. This goes through the entire thing. You need a catalyst. You need a gap. I encourage you to go and watch this on your own free time. But if we go back to TradingView, what I want you guys to focus on is there's going to be plenty of opportunities where we look at a stock and we go, I want that stock. I want that stock at this price point. I hope the gap or I hope the earnings doesn't shoot this thing up and over. Let's say you wanted Netflix right here and all of a sudden it opens up there. Are you still buying it? Hell no, you're not buying it. You know what happens when you buy and chase big gaps like this. This was a, how big? I don't have percentages on. Pretty big gap, though. Yeah, you're not chasing Netflix when it's up 8.52% at the open. There's absolutely no way. So what do? It's a great stock. We know it's leading the market. It's gapping and going. This is an episodal pivot for any of you guys that know that term, right? There's a big catalyst. Look at the volume. Everything is telling us that the market wants this stock for a lot higher than what it's currently going for. How can we get in? We have a setup called, we call it the COD. It's been called a million different things, but we're just, come on guys, just bear with me here. Change of direction. It's essentially what we're looking for is just a change of sentiment in the market. We call it a change of direction. Before it was going sideways, now it's going parabolic. We want to get in, but we have to get in at the right level, at the right price point. We don't FOMO and just chase. And this is where, once again, most people get it wrong. They're looking at the right stock. They see Netflix gapping up. They know that's inherently good, but price matters, guys. What you pay for the product matters if your intention is to sell it later at a profit. You have to make sure you're getting it at the right price, especially if you're trading options contracts. Once again, that's going to come back to haunt options traders if they aren't ready for that, right? So the first thing we need is some sort of catalyst. You need some sort of catalyst. It doesn't need to be an ER, right? It just needs to there needs to be something there that came out that pushed volume into the stock that was not normal. It's not always an ER event. It could be a headline. It could be a merger. It could be a correlated asset. For example, NVIDIA gapping up, at least at the beginning of the day, brought the entire semiconductor industry up, right? This type of stuff. That matters. So it needs to be some sort of catalyst that changes kind of the sentiment of the stock, and you realize that maybe Wall Street was caught off guard. You see the volume, everything else, right? Number two is you need a range to be set. You need a range. And remember, we just talked about that BRB concept. What happens when stocks pull back to the options contracts? They go down. What do you think a range does? Right? And then we need a breakout. So those are the three things that we're looking for inside of the change of direction setup. So let's talk through this. Now, this is a trade that we took as a group. I believe some people took call debit spreads. Other people took calls. This is a pretty big win for some of the traders inside of the development program right now. I only know this, by the way, because I have access to their trades through TraderView. So when I say this is a big win for some of the guys, I'm not implying that everybody has it. I'm just implying that it's something that we talk about inside of Discord, and I can actively see them managing it. And so I can talk about it, right? So if that's one of you guys, congratulations. This was a good entry. Right, so COD in particular, we obviously see the big gap up. And the cool thing is when you scan for this stuff and you see the big gap up, you don't need to go, shit, I need to own it now. Absolutely not. You can stock this thing, and that's the best part. Just like the BRB, which we scan through all the time, you're not buying the breakout, you're stocking it and buying the pullback. Well, from a COD perspective, you need a little bit more patience, because instead of just a pullback, which could occur, but I'm going to ask you a question and answer respectfully and honestly. If Netflix gaps up 8.5% and pulls all the way back, are you still buying it? Let's be honest. Probably not. And I probably wouldn't either. There's something wrong, right? Maybe the street got it wrong, or maybe there's some sort of market manipulation. You know, everyone likes to blame it on that. There is a lot of market manipulation, but hopefully we want to try to get away from it. Generally only impacts shorter term traders. But for us that are trading primary trends, it's a lot harder to manipulate a primary trend, particularly this beautiful instrument right here, the 200-day moving average, right? So Netflix, big gap up. We can scan for that. Then we can start planning. Okay, we wanted Netflix. We saw it the first day, gapped up. Yeah, we want it. Second day, gap and go. Oh, shit, maybe we're not going to get it. Third day, fourth day, well, let's keep it on the watch list, but let's keep it on the back burner for now, because what happens every single day that something gaps up and continues to run? Those options contracts just, whoo, they're gone. There's no way. You're paying like 500% more for the same contract the same guy bought it prior to earnings. He gambled, made out like a bandit, and you're chasing like an asshole. That's not a good situation to be in, because if Netflix all of a sudden pulls back, you're down, and you're also down a lot in dollars because you just paid 500% more than the guy that bought it prior to ER. We're not in that game. I don't care how valuable something is. I don't want to overpay for it. So Netflix, we put it on our watch list, and then all of a sudden something funny happened. Netflix consolidated over the next 2 to 3 weeks. Very, very tight range off of descending volume. We talk about this all the time, right? Descending volume in a tight range. All of a sudden, what do you think happens to those options contracts that were just up 500%? I mean, you guys are holding options contracts right now through some consolidation. Luckily, we didn't overpay for them. But imagine if you were paying $5 per contract on Netflix, and all of a sudden you get a 50% reduction in value. Those things are now worth $250. What happens if it's steeper than that, which absolutely happens all the time? particularly if IV starts to get crushed, right? All of a sudden you start sweating, you start second guessing yourself. You look at the setup and you go, listen, this is not a bad setup. We're still holding the gap. Man, the options contracts really suck. Well, guess what? When Netflix breaks back out, we're in it, because now all of a sudden we're not paying the $5 per contract. We're getting a steep discount from back at, somebody was buying Netflix up here. We're now buying maybe 50, maybe 60, maybe 70% off in certain circumstances, depending on how much IV got crushed during the pullback and the time it took for it to pull back. Once it starts to take off again, we buy it. As a matter of fact, we are planning to eventually own Walmart. You can see that the chicken scratch there is already kind of there, right? Come on, guys. Give you some credit. Walmart here gapped up off of its earnings report. This is a little COD, little EP action going on. Episodal pivot here. And our setup, the COD, is in play. And as we were talking about it inside of Discord, I think we were talking about it during the Sunday night strat session. So for those of you that have watched, I'm sure you saw this. We're looking at Walmart and we go, well, it's gapped up. It looks great, but we're going to want to buy it after a couple of days minimum of some sideways consolidation. We draw the proprietary upper range there, and we want to buy the breakout and resummation of the uptrend. What does that do? It gets us cheaper contracts, just like that BRB idea. So it helps us improve our risk to reward from a shares perspective as well. Obviously, if we're buying the range breakout, your stop loss is going to be very simple. Range low. If we fail and we come back down and we're back within the range, you're out. So it's a very tight stop. Once again, that's what skews risk to reward in your favor. Now, not all of these are going to work, right? We have taken COD setups that don't work, but the ones that do have tight stops and the risk to rewards are super high. So even with I don't want to say a high loss rate, because it's not a high loss rate, but even if you lose 2 or 3 of them in a row, the one that you hit is going to pay for the 2 or 3 that you missed. And then obviously if you hit 2 or 3 in a row, which happens frequently when markets are in uptrends, particularly around pivot points, next thing you know, you're in some pretty big positions that other people paid a hell of a lot more to get in for, right? So this is our COD setup. It's very valid. Excuse me. Hunt for these types of trades. You're going to listen to us as we scan through them on the Sunday night strat sessions. And if we ever have anything that comes up as a trade idea that says this is our COD setup, I usually link the article as well so people can watch the video. You now know what we're looking for. Catalyst, a range to be built for cheaper contracts, and a resummation of the uptrend on the range break. Okay? That's number 2. This is your breakaway. This is your gap and go. This is your COD. Last one I want to talk about is what happens if you're just in a stock that just friggin' runs. What happens? What do we do here? If there's a stock that runs and there really is no opportunity to get in, there's no real expectation for a pullback, there's no COD setup, and this is what we found ourselves in Sweetgreen and NATL, actually, which just came out last week. I have a smaller position in NATL, which we can look at in one second as well. So Sweetgreen, we actually had the idea on the books when we saw it gap up off of ER. So once again, this is your EP. We were stuck within a range for a year and a half, 2 years. We see this big gap. Hey, that's on our radar now. But the way we like trading, particularly with Sweetgreen, because this particular setup was hitting everywhere, this was a stage 1 accumulation, right? We have the classic mountain volume there. We have financial institutions accumulating. We had a beginning to have at the time, we had a beginning of a upslope in the 200-day moving average. This looked really constructive, but we didn't know if we wanted to own it yet until it got up and over this 19.5 level, because that was really where the stage 2 in our mind, particularly my mind, that's where it really started to get going, right? If we get up and over that 19.5, that previous little level in 2022, then I think party's on when it comes to Sweetgreen. And so what we did is we saw the EP, right? It's very obvious, big gap and go. And instead of playing it as a COD setup, we said, let's just buy it on the 19.5 breakout and just get in. That's it. We're not going to worry about a whole lot. If it's up near 19.5, we're buying it. And that's exactly what we did. As a matter of fact, we bought it right here. We didn't wait for it to pull back. We didn't wait for it to consolidate. We were kind of lucky that over a few days prior to the 19.5 pivot that it did consolidate. So we did get, I don't want to say cheap contracts, but we didn't grossly overpay for them. If this thing continued to accelerate the way that we thought it was going to, we might have been priced out, but it didn't. It slowed down a little bit into the overhead supply at 19.5. And this was one of those trades where, unfortunately, guys, you have to be at your seat. That's one thing I'm going to tell you. Somebody, there's always whenever a newer trader comes into the Discord, because we run 2 live sessions per day, one in the morning and one at night, the classic question is always, hey, I have time to be here, but realistically, is the morning session more valuable or is the afternoon session more valuable, particularly for executing trades? And there's this old adage specifically for swing traders and position traders that the close knows, that the closer you can get to the market close and executing orders over time, you're going to have edge there, right? We don't particularly want to play with the day traders and the high frequency trading firms and the algorithms at the market open. That's not our shtick. Our shtick is primary trends and gaps. We like to play for the overnight moves. We're momentum style swing traders. We expect things to move in our favor overnight. The reason why I'm telling you this is this particular type of setup, sometimes by end of day, there is no more setup. You missed it. Now, not always. And like I said, I always get this conversation in Discord, so I might as well explain it really quick. Over time, what you'll realize, and what I've seen over the last 2 years of reviewing TraderView data, where I specifically look at this stuff, is that traders that only execute orders in the morning versus traders that only execute orders in the afternoon, they tend to even out. There's going to be some trades you take that are better in the morning. There's going to be some trades you take that are better in the afternoon. If you can't help it and you can only execute in the morning, don't feel like you're not going to perform as well. It's about the same. There might be like a very, very slight edge because of market on close orders towards the end of the market, but it's negligible. Don't let that stuff keep you up at night. The reason why I keep bringing it up is, unfortunately, with something as aggressive as a sweet green play, if you waited until the end of day, you're going to get just a worse fill than everybody else because you have to be there at your seat. And that's unfortunately just part of doing business in the market. If you're trying to trade an aggressive breakout, early bird gets the worm type of scenario, and so your ass is in the seat and you're ready to execute orders, or you just take a partially worse fill, right? But I want to talk through 2 different scenarios on how we do this inside of the Discord, and I want you to emulate whichever one in your own trading that makes the most sense. Now, we have a trader named Mike. He's been trading with me specifically for 4 years. He's been with TTI since 2020. He's the most valuable asset that we have inside of the Discord, in my opinion. Although we have traded together and we have very similar styles, Mike sees the market very, very differently than I do, so it's really fun to bounce ideas off of him. The reason why I bring this up is he enters trades differently than I do. And one way that he does it, particularly on these breakouts that we're just ready to get in, right? We can't wait for a pullback, or we don't want to wait for a pullback, or there's no COD setup coming because maybe there was already a gap and it's just we have a level, right? What he likes to do is he likes to cut up his R position. So if you read the position sizing guide that's on Circle, you know that we like to use this concept called R. I'm not going to go into it, but essentially it gives you an opportunity to quantify your one risk lot. How much are you willing to lose on a specific trade, right? So what Mike likes to do is he likes to cut his R up. So if you're normally trading 1 R, he'll enter something like a 0.5 R at the beginning of the day, a 0.5 R at the end of the day, or maybe sometimes he'll do a 0.25, 0.25, 0.25, 0.25. And what that's doing is it's just catching at the beginning of the day and the end of the day, and you're finding somewhere in the middle. So if you take off right from the very beginning, you have the best possible entry. That's great. You grabbed half of your position there. And at the end of the day, if you're closing at the high of day or whatever, you still want to get fully positioned, you're going to meet somewhere in the middle. Conversely, if you gap up, let's say on the day, and you're getting filled and all of a sudden it reverses, well, you just got the worst possible fill, but you're averaging it out at the end of the day with maybe one of the best fills, so you're somewhere in the middle as well. This kind of diversifies out the risk of buying a breakout candle because it's never perfect, particularly for those of you that work 9 to 5s, have companies, families, etc. You're not going to be glued to your screen the entire trading session trying to snipe these entries as swing traders. It's unrealistic. So by cutting up your 1R and just spacing it out throughout the day, you can kind of average your way into stuff like that. The other way, which is what I normally like to do, is I normally like to just go 1R, and I normally like to do it off of either the range high with a break above, or if it's a down day, I'm placing it at around 11 a.m. So before lunch session. Generally, if you look at any of the statistics between trading hours, and I encourage you guys to do this, that if you're on the market research side and you don't have me staring at your TraderView stuff and barking orders at you, I encourage you to look at your trading statistics from 11 a.m. to 3 p.m. If you're trading during those hours, I would almost guarantee most of you, and I mean this sincerely, are underperforming versus your 9 to 11 and your 3 to 4. The reason why is because generally after 11 a.m., volume and volatility drops off, generally speaking, and markets become more range bound. And range bound is not where momentum or breakout style of traders want to exist. This is more mean reversion stuff. Buy the oversold RSI, sell the overbought. You know how this stuff works, right? So what I like to do is, if I'm not in a play, right, if we're not in a breakout situation where if we have some sort of pre-market range, I can just set some sort of horizontal level. Market opens up and we breaks out. I just enter right here. We're not day traders, guys. We're just trying to get in for the long run. And this gives me an opportunity to get into something called a trend day. If it doesn't work out perfectly, I'm not sweating it. I know where my stop is, but hopefully on these big, strong breakouts, it is generally going to be a trend day. And so I can get in at market open and then I don't have to worry. Now, if it doesn't break out, let me remove this. If it doesn't break out, let's say we open up and then we immediately break to the downside down here. I'm not going to sit on the 1 minute chart and pretend I'm a day trader anymore, guys. 14 years ago, I did that. I probably should have been gray a long time ago because the stress that is incorporated with stuff like this, I don't even care. So if I'm not in a position, if for whatever reason we're meandering down by 11 a.m. when it's time to go to lunch, I'm just throwing the order on the books and I'm getting filled and then I'm going to walk away because wherever it is, generally speaking, we'll say we're down in the dumps. We're probably not going to continue to break down too much. We're probably going to find some sort of range and maybe even pop up slightly. I'm talking normally, sometimes like today, for example, which was just a nonstop sell order type of day. Normally, we don't hit new lows after 11 a.m., at least not aggressively until that 3 p.m. slot starts and volatility and volume kicks back in. So I don't really stress the entry too much. It's either the open range breakout high and I full order in, or I'm setting the order on the books and getting filled prior to leaving lunch. But the whole idea here is that we don't want to wait for the pullback in some circumstances. If the trade idea says, listen, the idea here is that there's probably not going to be a pullback, let's not do it. And the whole reason why we wanted to enter is that when you look at the actual breakout day here, it's hard for me to draw the arrow because it gets all wonky for some reason. That is not a high volume breakout, right? There is no real BRB opportunity there. This was a low volume breakout day. And once again, low volume does not necessarily degrade the performance of the breakout only by about a 1.6 or 1.9% over the long-term difference. But what it does do is it does not generally incorporate pullbacks as often. So generally these things break out and just continue to go, right? So Sweet Green breaking out, low volume. We decided just to get in right away and it ended up being a good trade for us. Didn't quite hit price target, but it was a good trade. It was a profitable trade. And then guess what? Obviously primary trend takes over. We get another gap up. And look at this. We just went through it in the last setup. What is this? A potential little COD. We get the EP setup. Maybe we want to get back long Sweet Green somewhere above 33, 33.5, something like that. These types of setups are everywhere in the market, and they're very valuable, right? So those are the three types of setups. We had the BRB, which is our bread and butter. We had the COD, which is more event-driven. They're not as common, but they are powerful when we can find them, particularly because we're not in a rush to own them, right? We can stock them. We can plan for them. It's a lot easier to enter these things and we can take our time. Generally, when we can take our time, we make less mistakes. And then these types of situations that are a little bit more quicker and faster paced, obviously you have to be ready to execute the order. If you're not, that's okay, but make sure that that is part of the game plan, right? Part of the game plan is knowing that you're not going to have a lot of time to execute this. So just get it on the books and walk away and let the market do its thing. Before I call it a session, the other one, I guess, really quick that was kind of like this was NATL. 2 or 3 days ago, or I think it was last week at this point. Days are going really, really quick here. NATL was a great example of one of those things that probably wasn't going to pull back, and it didn't, right? So I got in. I did not get in at the best entry point. I didn't even double think it. I just said, listen, this is a breakout. Looks like it's going to continue to rip. I want a part of it, and so I just grabbed it. And I'm up on it. Not a lot. Didn't get the best fill on it, but this is something that I knew I wanted to be a part of, and at this point, it's a free trade. So if I get stopped out, there's no account capital against me. Hopefully this continues to go up, but this is another one of those type of Sweet Green style plays that just completely took off, and there was very small chance of a pullback, so I pulled the trigger on something like this. Right. Before I call it a session, do we have any questions regarding those three? Go back to SPY here, and we can look at the breakouts, the pullbacks, or the gap and goes. Do we have any questions regarding any of them? All three of these are incredibly important. They're all used in different scenarios, but all three of these are designed to do two things. One, skew risk to reward in your favor, and two, take advantage of naive traders that don't understand volume and breakouts in general. Right? Momentum tends to beget momentum. When we're into these types of breakouts, they tend to continue to break out and exist, but it doesn't mean that they're going to just go up endlessly. We've developed these rules to get us in and take advantage of some of these guys. We like to buy cheaper contracts. It makes me feel good knowing that we're buying bags off of people that think they bought a bad trade when in reality, They just had very poor expectations for the trade. We will gladly take those contracts off them for 50%. From a shares perspective, I would way rather take a 4, 5, 6 to 1 setup than a 1, 2, or 3 to 1 setup. Over time, those small, minute differences add up, particularly if you're on a hot streak, guys. All right, I appreciate your time. Hopefully this webinar helps. Once again, read the articles on Circle. There's one on BRB. There's one on the COD. There's videos on that. There's all the stats behind them. It's important to understand those concepts because when they come up in the trading ideas, you're going to know how to execute them. Hope you guys enjoy your Thursday night. I'll talk to you in the morning.